Hello everybody, welcome back to Economica. Welcome everybody, and today I'll try to give some answers and some hints on the what's about of the yield curve. So why long duration yields are rising? What is going on in the sovereign debt market? And this topic is wide, is huge. There are a lot of factors at play in the economy, in markets, and so I'll try to provide as much data as possible and some explanation on why the yield curve has been rising in long duration. Nonetheless, while central banks are trying to cut interest rates. So, as we can see from this page, we're starting from the macro factors of the United States economy, and a couple of factors that have to be considered for the yield curve are the primary account ratio to GDP, and we see that the primary account is minus 3%, and the government budget is minus 6.2%. So if we go on the chart, we see that the primary account for of the GS economy the past year was minus 2.75%. 2023 was minus 3% and minus 3.8%. So we see that basically the United States, like so many other advanced economies, they run their fiscal policy with a structural primary account deficit. So basically the state or the federal government spends more than earns in tax revenues. And we know that clever corporates, they are very clever to avoid tax around the world, but this is another topic. Let's forget about Citus asset management. Well, anyway, so then we see that from the primary account we have the budget. So what is the percentage ratio of the overall budget, fiscal budget spending to the GDP? And we see that the overall budget deficit to the GDP it's larger. It's in 2024 was minus 6%. We can see in 2020 was minus 14.7%. So the government was spending 15% more than it was taking in tax. And if we zoom out this stuff, we see that basically the United States has never, almost never, had a fiscal surplus, but the budget, the fiscal budget ratio to GDP, or the budget value to GDP, basically exceeds by a large margin, minus 6, minus 4, etc. And this is a determinant factor for which today the debt to GDP ratio is 122%. So when you have structural fiscal deficits year on year for decades, then the debt basically piles up, and you end up with a debt to GDP ratio which is larger than what is the aggregate of the whole economy, gross domestic product, goods and services, etc., etc., etc. So this is a factor for which basically all large institutional investors, which is pension funds, insurance funds, large banks, investment banks, whatever, it's in that bubble world, they basically ask a higher yield for basically buying or lending money to the government. It can be the United States government, it can be the UK, it can be Germany, it can be France, it can be Venezuela, it can be the Banana Republic, it can be Zimbabwe, it can be anything. So basically these are the mechanics of how this stuff works. So this is the primary factor, which are fiscal deficit. Then there is inflation, which is a factor. So the higher is inflation, the higher is the yield that it's required for to have a positive real yield. But setting aside the macroeconomic factors, I want to focus on something that is more interesting. It's part of the mechanics of the flow of funds or the cash flows that investment banks or any investment funds has to work around with. So what happens is, basically we have a situation I think in all banks, also in some central banks like in Europe, or that since like a couple of years, we have seen everybody knows that interest rates have gone up. Like the Federal Reserve went up to 5.5%. So all central banks have increased interest rate because inflation was higher, and this has been a determinant factor for which banks that have been holding sovereign debt bonds, they've seen on their balance sheet the value of these bonds decreasing, because when the yield goes up, the price of the bond goes down. So all these banks in Europe, in the United States, they are stuffed on their balance sheet with sovereign debt, which has been issued in the market like 5 years ago, or 10 years ago, or 20 years ago, which is long time ago. So these debt securities, they had a market yield on the issuance that was, for example, on average was 2%. Now the yield is 4%, 4.5%. So this difference in yield makes the bonds that these banks are holding less valuable. They lose value. The price goes down, and these basically become unrealized losses, because these banks, they hold, like also the central bank. Like, for example, the central bank in Belgium and other euro area central bank, they've been working with negative P&L. So they've been holding sovereign debt which was issued like at 0% yield or 1% yield. So when the yield curve has gone up, all these central banks have been holding bonds that have lost value in their price, what was the nominal price. So we see that the situation for the banks in the United States in the last 3 months, in the previous 3 months, was a minus 364 billion in the overall amount of we see investment debt securities for banks of unrealized losses. So these banks, they have these bonds on their balance sheet. They don't give a damn, because they bring the bond to maturity and they take the coupon, and that's it. They don't have the need to sell these securities, otherwise they will have to take a loss in the market. And we see that in the previous months, or in 2022 and 2023, when interest rates started to go higher on a very rapid pace, we see that this loss was minus 600, minus 700 billion, which is large unrealized losses. So this still is a quite a large, sizable hole in investment banks' balance sheet. So this problem, when there is when market yield change, there are 2 factors. One is the duration mismatch. So on the asset side, I have of a bond portfolio, I have a certain duration, which can be 10 years, I don't know, 12 years or 7 years. It depends what is the composition of the bond portfolio. So when, I don't know, Paul goes to the bank and says, okay, I want to invest my $100,000 in a bond portfolio. I want to invest in treasuries, okay, or I want to invest in European sovereign debt. The investment banks says to Paul, okay, I have this kind of fund where you can invest, I have this kind of product where you can invest. So they take a lot of bonds, and they have an average duration. It can be 5 years. So the investment bank, the banker says, okay, for how long you want to invest? 5 years, 7 years, 10 years. So according to the horizon of the investment, then the duration of the bonds that are fed into this portfolio, basically it's calibrated. So an average duration can be 5 years, 7 years, 10 years. Now I'm going into side arguments, I'm digressing to the thing. So there is the first argument is that there is a mismatch duration. So the asset duration is not aligned with the liabilities duration. So if I have assets which duration is 5 years and my liabilities are in 2 years time, so there is a mismatch of duration. It means that I will have to pay my clients in the next 2 years, but my asset, they don't arrive to maturity in 5 years time. So how I can balance this mismatch? Okay. And then there is another problem, I believe, and this is my guessing. Okay, so there can be a cash flow mismatch. Okay, so basically when I have a portfolio and I'm collecting coupons or yields that are 2%, but then the market yield changes and it's 4% or 4.5%. Potentially, it depends on what kind of investment I've sold to clients. I could have a mismatch of payout in yield. So if the yield has gone up, the premium that I have to pay to clients is not 2%, but it's 4%. So how do I make up? How do I make about this difference in yield, which it's not only is a duration mismatch, but it's a cash flow mismatch. So to do all of this, there is a technique which is called portfolio immunization. So why we do portfolio immunization? We do portfolio immunization when we want to immunize, let's say when there is the flu season, okay, perhaps, and we don't want to catch bad flu viruses, and we want to immunize our portfolio. So immunization is made basically to make sure that the bond portfolio is less and less sensitive to interest rates volatility. Okay, so you can all understand that when central banks, they've increased the interest rate, so all bond portfolio, suddenly they've had a shock, volatility shock to their bond portfolio, to the duration and to the yields and to the bond price. So basically, I believe that the basic strategy to it's not I believe, it's in old textbook, the basic strategy to immunize the portfolio from interest rate sensitivity and interest rate volatility is immunization. What is the purpose of immunization? So As I was saying, it's I think it's better if we take this. Okay. I will jump from one thing to another. Just follow me. This is very interesting. It's very interesting. Follow me. Okay. I have a portfolio that I started in 2015. Okay. Let's go back to this. I have a portfolio that I started in 2015. The average for 10 years. So I sell this portfolio to clients. I have a 10 billion exposure. Okay. So in 2015, the average 10-year yield was 2%. In 2025, when the portfolio arrives to maturity, but this is the case for every period between 2015 and 2025, the average yield for the 10-year is 4.5 or 4.6%. So from 2 to 4.5 or 4.6, there is a difference of 250 to 260 basis points. So this yield differential, it could be a factor of cash flow difference. So I'll have to pay a higher compensation to the clients that have invested in this bond portfolio. Okay, so how do I do this? If the portfolio is maturing and I cannot invest in another, I cannot buy. If I have to pay out the portfolio in 2025, for sure I cannot buy another 10-year treasury and wait another 10 years. What I have to do, basically immunization, is to short, so to sell. Well, there are two techniques. Basically, the most neutral technique is to take the coupon. So the coupon that the bond portfolio earned from the long duration bonds, and reinvest, utilize that liquidity to buy short duration paper. So you take the coupon that the funds earn from the 5-year or 10-year. The coupon is paid every 6 months, so it's twice every year. You take the liquidity and you continue in buying 1 month, 3 months, 6 months, at the maximum 1 year notes, 1 year paper. Okay, so the average yield of it's here. So the average yield of a 1 month US Treasury paper is 4.3%. The 3 months, the 90 days, it's 4.3%. So more or less it's similar. The 6 months is 4.2, the 1 year is 4.1, etc. So by utilizing the immunization technique, I can basically harvest yield in the short term, which is 4%. So remember, we start in 2015. The 10-year average yield of bond portfolio of 10 billion, it's 2%. Now fast forward, we are in 2025, and the average yield is, let's see what is the yield now, 4.25. okay, 4.25. So we have from the starting point in 2015 2%, in 2025 we have 2.25% difference in yield, and this basically requires that every now and then I have to buy and add into the portfolio short-term duration, short-term paper, 1 month, 3 months, 6 months, 1 year, to basically balance this mismatch in yield. okay? And also the mismatching in duration. And the immunization, basically in buying this short-term paper, which has a higher yield than my portfolio when started in 2015, let's say, it was 2%, basically the immunization, it's useful, sorry for my crap accent, it's useful to basically protect the bond portfolio from interest rate volatility, because I'm adding short-term assets, 30 days, 90 days, 180 days, that yields basically what is the prevalent yield in the market. It can be 4.6%, 4.7%, 4.3%. So I'm doing a balancing act of basically balancing this difference between 4.25%, that is the average yield in 2025, and 2%, which was the average bond portfolio yield in 2015. So to do this, basically I have to buy more short-term debt, short-term paper, which is 1 month, 3 months, 1 year, etc, 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 and I'll have to basically also somehow sell long duration debt. So I will have to basically sell the 30-year treasury, or sell the 10-year treasury, or sell the 7-year treasury. It depends on what investment banks have in their portfolios, on their balance sheet, and I don't know that. What I'm trying to do, and I'm trying to explain what are the mechanisms, more or less, because I'm not an investment bank. I've learned this stuff on textbook, and so that investment banks can immunize their portfolio, and they can protect their clients' portfolio from interest rate volatility. So they can reinvest the coupon from that they earn from the long duration debt into short-term duration, or also while they reinvest the coupon, they can sell before the maturity, before the 10-year or the 5-year bond maturity. They can sell the debt security. When they sell the 10-year treasury, or sell the 30-year treasury in the market, of course the yield, the mark-to-market yield goes higher. Okay, so that's why I think there is also a dynamic of portfolio immunization that derives from this situation here, which is the unrealized losses on balance sheet that banks have. So if they have a portfolio duration mismatch, and if they have also a cash flow problem, in terms that they have to pay higher premium, because we start with 2% yield and now we are 4.25 or we are 4.5%, they have to find the liquidity to balance this yield difference, which is 2.something%. So they go and buy more short-term paper, because it goes to maturity immediately, and then they earn the yield on that short-term paper, while also they try to basically slowly sell the long duration debt, so that they also decrease the risk of holding long-term debt. And we see here an example that bond portfolio of 10-year, basically the duration of the bond portfolio, it's 11.6 years. It's not 10 years, because bond, I'm not gonna explain, because I'm not in the position to explain the macro duration and the modified duration, because I can't. I know what it is. I've studied it, but I can't. But anyway, when you see that the 5-year US Treasury or the 10-year US Treasury, so basically what happens is when the yield, the mark-to-market yield varies every day, also the duration, the effective duration of the bonds changes. Okay, so for every certain percentage change in the interest rate, in the yield of the bond, then you will have a modified duration that can be calculated, and it's called Macaulay formula, Macaulay duration, and then modified duration, etc., etc., etc. So this is basically a Python simulation. So bond portfolio 11.6 years, and then we see that the total are after immunization, the bond portfolio duration it's modified by 0.31 years. So there are some months are so the maturity horizon of the whole portfolio is modified by minus 0.31, okay, and still the unrealized loss would be minus 5.44 billion. This is a simulation on a 10 billion very large bond portfolio, but you can see that from the chart you can see the blue lines, the blue bars are the bond allocation, the portfolio allocation before immunization. Okay, so I have an allocation that is exposed to 5, 7, 10 or 30 year bonds. Okay, now I want to immunize the portfolio, and I basically switch a little bit the allocation after immunization to short-term paper, 1 year, 6 months, 3 months, 1 month. So this is not perfect, but by no means is perfect, but basically is to have an idea of what can be the reasons and the flow of funds mechanics that can be basically the factors that are at the base of why yields are rising for long duration yields, 5 years, which is medium duration, 10 years or 10 or 30 years bonds. So their yield has been increasing or rising in markets. So there can be an element for which funds, they are selling long duration and they are reinvesting in short-term duration, either for a mismatch in portfolios, also for a cash flow mismatch. So they have to pay clients an higher yield. So to find this higher yield immediately, they buy short-term paper, while they don't buy long-term bonds, or they can even sell long-term bonds to rebalance their portfolios. And these are more or less not so well explained, the mechanics of immunization. Okay, so this is another simulation, and basically the unrealized loss is minus 3 billion. So these are all basically machine factors, or these are Python simulation. So it leaves the time that it wants, but it's basically is to have an idea of why where is my it's here, why banks have unrealized losses and how they have tried to manage these unrealized losses. One method to manage this stuff is by immunization. So buying short-term debt, be positioned in the short term part of the yield curve, and being and then trying to sell the long part, the long duration bond. And another factor that we have to keep in mind is that the 1-year treasury yield is the most relevant yield for monetary policy. It's not even the 1 month, 3 months or 6 months. In monetary policy theory, the 1-year yield is the most correlated to federal funds rate. So what we see here, which is 4.17%, it tells us that in a year time the market still expects that federal funds rate will be around 4%, so around the levels that are today. So we try to explain immunization, which is this very nice process of immunizing the bond portfolio by selling the long duration bonds and reinvesting into the short duration bonds to immunize the bond portfolio from short-term interest rate volatility. Okay, and this can be utilized also if basically you have unrealized losses in bond portfolios. Okay, this is another simulation that basically tells you the steps, how we can see the blue bar is before immunization. We see, so the allocation goes down to here. So after I start the portfolio that I am fully invested in 30-year, 10-year treasury or 7-year treasury, etc., etc. Then I do immunization and I switch. I sell some 10-year treasury and I get rid of all the 30-year treasury, and I reinvest everything into 1 year, 6 months, 3 months, 1 month. Okay, this is basically to immunize the portfolio from interest rate volatility. Okay, so what to do next? What would we do next? We're going to analyze basically what is the volatility, what are going to be the average levels of yields going forward. So we can start here from this, which is a forecast. Okay, so how yields are going to evolve going forward. So here I utilize two models, which one is the Vasicek model, here Vasicek, and CIR, which is the Ingersoll-Ross model. So basically these are two models that are made to forecast 10 steps forward what would be the level of interest rate. And so we see here in these charts that the orange line is the Ingersoll model and the blue line is the Vasicek model. So the 1 month treasury, it could be rising according to the Cox-Ingersoll model even to 5.6%, and this basically could be maybe the outcome of a fiscal policy shock, some sort of problem in the treasury market, because these are when you have short-term debt that the yield goes higher, then basically it means that there are some liquidity problems in the bond market. But we have to make a very important distinction. The CIR model, it only works with positive interest rate. the Vasicek forecast, it's also able to work, the equation of the Vasicek model, it's also able to work with negative yields. So we have to bear in mind this technical distinction between the two models and just keep an eye on it. So 3 months forecast. So we see here the Vasicek says that the 1 month treasury note will stay around 4.2%. The same is for the 3 months, but the CIR model basically tells us that there could be some short-term volatility in the next 2 to 4 steps forward, 2 to 4 months, and then we see that it declines even below the levels that are now, which is 4%. It gives a forecast of 3.8%. Let's see the 6 months treasury notes. So we have a near-term volatility, and we will have basically a decrease in yield, even as low as 3%, and here it's more or less it's the same, 3.8%, same levels. 1 year treasury, okay, the Vasicek model here starts to show up with some volatility, and it's divergent from the CIR model, and basically the Vasicek shows us that the 1 year treasury should follow with some volatility and go up to 4.5%, stay there until June next year, going here, and then declining to 4.4%. But this is basically a 10 basis point move up and down for the Vasicek model, and the CIR model, this is 4.38, 4.4. We are more or less at same levels. So overall, the 1 year treasury today is 4.1. The Vasicek model tells us that there could be some volatility going forward and higher yields in 2025. 2 year treasury, okay, CIR model is a rise 4.55. The Vasicek model forecast is for 4.4%. So here we have a fork of 15 basis points. Mark-to-market yield is 4.27. So both models, they are forecasting higher yields next year. Same, it seems to me, for the 3 year treasury, which is for the orange line is 4.5%. Also the Vasicek forecast is very close, it's 4.48, 49. So we are in the same box here of a 4.5% for the 3 year treasury, and it would be a 16 basis points move on the upside from the market levels that we have today. 5 year treasury, okay, yes, also the forecast is for higher yields next year. This is very intriguing, because the Federal Reserve is supposed to cut interest rates, so I'm not so sure. We have to be very focused on the fact that the Python simulation, it's made only with yield curve data. So the data that it's in the machine, it's only the data from the yield curve. So there are no other exogenous factors as fiscal deficit, or not even the bond price. So the forecast for the yield, just only for the yield, it's showing us that basically for all the treasury yield curve, there should be higher yields in 2025. So we see the 5 year could go up to 4.5%, and the 7 year could go up to 4.7%. Here we have some divergence. It seems large, but if we read here, we are 4.7, 4.62, it's basically we are there. 4.6, 4.7%, 7 year. Let's see, 7 year. The market yield today is 4.5. So we are, I think that on average, we are talking about 15, 16 basis points higher for the Treasury yield curve in 2025. Sorry. This is very tiring. So again, orange line higher, 4.75, 4.6% for the 10-year Treasury. This is a very important benchmark for all the financial markets. And today we are at 4.66. So yeah, we are here. So the Vaz-Check model tells us that the yield should be lower. Okay. The Ingersoll-Ross model tells us that the yield will be higher a little bit, 10 basis points higher, 4.76 instead of 4.66. 30-year Treasury, last but not least. Okay, so here we have declining, some sort of volatility. On average 4.9, almost 5%. What is the yield today? The yield today is 4.89%. So we are going from 4.9%, a few basis points higher, and then we will stay at basically at same levels that we are now in the market, 4.89%. We have to consider also that when the coupon yield is less than the market yield, then the bond price is below par. And this means that if the US Treasury Department wants to issue bonds 30-year Treasury at par, they will have to pay a coupon which is not 4.5% but 4.9%, a higher coupon. Okay, these are all the bonds mechanic which are interesting but very boring. So I then also did some volatility research on the yield curve to see what are the rolling standard deviation levels, the 30 days average yield for all bonds, and I used also the typical Garch models, which is the Garch, E-Garch, and also another complicated, which is a GJR Garch. But anyway, here we can see the variance volatility. So these numbers we will have to square it. Let's see if we do a funny game. Okay, no, not the calendar. I need the calculator. I need a calculator. Okay, so 5. The eGarch model has a forecast for the next 12 months that the variance volatility, so let's say the vol of vol, it goes from 2.5, 3 to 5, but this 5 will have to have the square root of 5, right, which is 2.23. There is some noise somewhere. Can you hear this noise? Right, it's beautiful. Let's carry on. So basically, if we do the square root, this is 2.23. So basically, let's say this is 2.23 standard deviation. Divided by 100. So that should be the volatility in percentage points, which is 0.022, which is 2.2% more or less, or 0. Well, this is more or less, it's the how to understand these charts. Okay, so basically the Garch and E-Garch models, which are made to understand what is the conditional volatility in the yield curve, they all charts, they all give me higher conditional volatility, and especially the E-Garch model, their efficacy in capturing the asymmetric volatility shocks in all discrete time series. So we see that the forecast for volatility of the Treasury yield curve, it's higher. Okay, 1 month, 5 units of variance of volatility. This is the 3 months, and we see that the E-Garch, it forecasts much higher volatility than the Garch model, which is pretty much flat. Here we have a top of almost 5 units. This is the 6 months. So now it's important that we pay attention to this thing. So the Garch model, let's compare these charts. Okay, the Garch model is telling me that the volatility for short-term paper, 6 months, 3 months, okay, stay with me, follow me, stay with me. So the volatility for 3 months short-term paper, 6 months short-term paper, it would be pretty much flat, or would be the same for the whole next 12 months, let's say for the whole 2025. And when volatility is low, it means that there is investors in market, they are willing to buy, to have in their bond portfolio more short-term duration, 6 months, 3 months, 1 month paper, short treasury notes. Okay, but when we move in longer term duration, 1 year, 2 year, 5 year, 10 year, we can see, or 30 year, okay, we have some sort of contrarian, but we can see that also the Garch model comes up with some volatility, which is pretty much higher, because we have here 4 units, 3 units of volatility variance, but here we are talking about 22 and a half, 22 units, which we have to do the square root, and then we see that the percentage is like a 4 something percent in volatility. Okay, so if we take let's do a funny joke, let's take the wrong, this is wrong, just only the square root. Okay, some sort of 4.69% vol. Okay, vol. Vulova. Okay, so so we were saying that also in some longer duration bonds, also the Garch model then starts to capture, to get from the data higher volatility, and we see much higher numbers here in volatility variance for the Garch and E-Garch model. So also the volatility models, they are all highlighting the fact that there should be higher volatility for the Treasury yield curve, but this will be for all sovereign debt bonds. And then probably we will talk about what's going on with the gilts yield market. And yes, these are other charts which are the same. So it's volatility of variance, and this is very, very important. I think these are very nice charts because they basically, through the Garch and eGarch model, they give you a forecast of what is the volatility of variance in or the variance volatility forecast in the next 12 months. And yeah, if we take the square root of 20, we will see that it will be about 4 point something. Beautiful, beautiful, fantastic. Right. Square root of 20 is 4.47 sort of percent or something like that. Okay. So now we are basically bringing together some points. So we have gone through the immunization process. So to immunize a bond portfolio, I want to have in my portfolio short-term paper, 1 month, 3 months, 6 months yield treasury notes, and the Garch model tells me, okay, for the next 12 months there won't be so much volatility, but the blue line. So this could be a data point that tells me, okay, the market will be positioned in the front end of the market, in the front part of the market, buying 1 month treasury notes, 3 months, 6 months treasury notes, buying the 1 year treasury, buying the 2 year treasury, also to play around the inversion of the yield curve. But both Garch and eGarch, they tell me, okay, the belly of the yield curve, the 3 year, the 5 year, the 7 year, they will have higher volatility, also the 2 year, which is very counterintuitive, okay? And there will be higher volatility for long duration, 10 year and 30 year, because again, the values here are 26, 25, 24. So the basic vol, even in a Garch model for the 10 year, let's take 24.5, let's have the square root, we are talking about almost 5% vol of vol, okay? Instead, the basic volatility for a 6-month paper, it's 2.5, square root of 2.5, it's 1.6%, okay? And the top volatility for the eGarch model, it's 4.5 square root 2.1%, okay? So the basic vol of a 6 months treasury note would be 1.5, 1.6 to 2.1% volatility. The basic vol for the 10-year treasury, the 10-year or the 30-year treasury, we are talking about 26 variance or 24 variance. And let's do again the square root. Okay, 26.25, rubbish. Let's go back. 5, let's take the square root, this is 5.12, right? And square 24.5 square root 4.95. Okay, so we are talking about this kind of standard deviation magnitude compared from 5 to 5.12 compared to 1.6 to 2.1. Okay, so the volatility in the short duration, okay, the near term debt, 6 months, 3 months, 1 month, it's gonna be much lower for all 2025. So the yield curve brings you a data point which is very important. Investors at this moment in time, for all the data, they are buying short-term debt and they are shunning away from long duration, from the 10-year or the 30-year, which have higher volatility, 25 variance, 24 variance. So this is also these are data points that go together with the immunization concept. I want to have in portfolio short-term paper which has a good market yield, 4.3% on average, or 4.2, 4.1%, okay, rather than have a 5-year bond 4.4%. So I have a risk of 5-year debt security which yields 4.4 and the coupon is 4.3, which it's the same that investing in a 3 months paper. So 3 months paper, I get 4.3% yield. A 5-year treasury bill, it's 4.3 the coupon, so it's basically the same. So in 3 months, if I rinse and repeat, I buy 3 months, 3 months, 3 months, 3 months, 3 months, I do like a strip of cash flow of 3 months. I've replicated a 5-year bonds, okay, for the coupon. I've replicated, I have the same cash flow, but I don't have the risk that my money is parked for 5 years and then the yield goes up and down, and then the bond price goes up or down, and I have basically unrealized loss. What do? I buy short-term paper 1 month, 3 months, 6 months, and then I replicate the same cash flow because the yield is the same. Okay, this is the trick, the joke that in the market it's necessary to do, and this goes back to the point that the volatility in short-term paper it's lower, while instead the 5-year or the 7-year or the 10-year they carry a lot of risk because the duration of the debt security it's longer. It's 7 years, 10 years, 30 years. Who would bear the whips and scones of time? Okay, so who wants to have a bond for 30 years on its stomach, and stomach all the yields, the interest rate volatility? So the volatility model, the Garch and Igarch model, also demonstrate that there are some element of immunization in market. So investors, they are not stupid, they want a lot of money, and if they can make the same money in 3 or 6 months instead of waiting for 5 or 10 or 30 years, of course they will choose the near-term bonanza. But this basically brings other financial stability problems, because when the government wants to issue 5, 7, 10 or 30-year debt, then they will have to pay a higher yield, and this becomes a problem for fiscal policy. But then there is another policy, another problem, which is financial stability, because the 10-year treasury and the 30-year treasury, mostly the 10-year treasury, they are the most liquid and safe assets. They are used in repo markets, they are used for collateral, they are used basically to raise liquidity, to raise funds in markets. And so when this, basically, if I post as a collateral a 10-year bond, a 10-year treasury, and the bond price goes up, then I'll have to pay more. I'll have to pay a premium for that to my counterpart. Okay, so there are a lot of things which are very fascinating. So we covered the Vasicek and the CIR models, and we see that they give us somewhat of higher yield curve in the next 10 to 12 months. We have seen that the Garch and Igarch model tells us that the unit of variance volatility for the 1, 3 and 6 months treasury notes it's much lower than longer or medium duration treasuries, which tells us fits into the picture that there are elements of immunization in markets. So the investors are buying short-term debt. So let's see what else we got here. Okay, these are other Volatility forecasts, which give us some different outcomes, but more or less we see that the yields are more or less the same, but the outcome, we have higher yield curve for the next 12 months. This is a forecast for the 2-year. We can compare with the mark-to-market yield. Yeah, we are 4.26, 4.27, and the forecast is 4.46 going up to 4.5%. So these are very interesting, and basically if you want to incorporate for risk management these kind of models, then you'll have to hedge your bond portfolio for higher yields. That means that the bonds that any investment fund is holding, they will decline in price. So okay, these are the first difference, because we want to verify the stationarity, and then we have the usual quantile charts to see the theoretical distribution, and we see that there are fat tails, but the value are 0.2 minus 0.2. This is the distribution of the standardized residuals, which is pretty much symmetric to 0. Nothing very special here. Yes, these are the stationarity. Okay, this basically, it's a very complicated model to forecast the volatility, but we will skip on this because it's complicated and I don't have the theoretical means to explain. And okay, here we have a Nelson-Siegel model. So let me pick up the script and find the explanation of this, because I've learned it today. But so basically the Nelson-Siegel model decompose the yield curve in 3 factors, which is the level factor, the slope factor, and the curvature factor. So a positive curvature factors, it will tell you that basically the belly of the curve should see the yield curve rising. Okay, the slope factor, it's a correlation factor of the slope of the yield curve. So if the slope factor is positive, it will tell us that basically the 10-year treasury, the 30-year treasury, or the 7-year treasury yield will be higher than the 1-year or 2-year treasury or the 6 months treasury. So there is a disinversion, a normalization of the yield curve. Okay, so we have an upward sloping yield curve. So the yields on the short-term duration bonds are less than the long duration bonds, and the slope factor basically describes the normalization of the yield curve. When the slope factor is negative, that is the moment when you have a yield curve inversion, where to say that it means that the short-term duration yields are higher than, so basically the 2-year yields, it's more than the 10-year yields. So you have an inverted yield curve, and this is visible with the Nelson-Siegel model in the slope factor. Negative factor, you have an inverted yield curve. Now we have a positive, we are at 0, we are at neutral. Okay, so the treasury yield curve it's basically flat around 4 and something percent, but if we go for a positive slope, that means that the yield curve is going to normalize, okay? And we can verify here, for example, that we see 4.3 basically in the short-term paper, 4.3, 4.2, 4.1, and then we see that the 1 month or the 3 months paper, they have the same yield as the 3 year. So the yield curve basically is flat. It isn't really a normal upward sloping curve, but it's the slope factor is neutral, but somewhat the yield curve is normalized because the spread between the 2 year and the 10 year now it's basically it's positive. So the 10 year is 4.6, the 2 years 4.2, so the yield curve has normalized, okay? And so the Nelson-Siegel model basically helps us to understand all these features. And then these are basically the charts of Garch, eGarch and GJR Garch model to see the conditional volatility. It's somewhat subdued, but we have had a spike in 2023 vol, and basically we know that if we incorporate this part of the chart where we are having, that we're gonna have higher volatility in the next 12 months according to Garch and the Garch, then we can basically bring forward this data and we can argue that this model will see higher volatility, okay? So these are all very important for risk management, and I think happily we are going towards the end of the video. Let's see if I go back to the code. Yeah, okay, so here we have basically the 30-day rolling mean yield. So basically it's the average every 30 days of the yield, and we see that for the 1 month the average yield would be here around a little bit more than 4%. I should have the tables somewhere, but we can see from the chart, yeah, 3 months. But the 2 year, the average yield, not the day-to-day yield, but the average yield will be slightly higher. So we have declining average rolling 30-day rolling mean for 1 month, 3 months and 6 months. So again, the notion that short-term paper average yield is gonna be lower, is gonna decline because investors, I think they're gonna buy short-term paper, while the longer duration, the medium to longer duration bonds, they will see an average 30-day rolling mean yield going slightly higher, okay? Because this is an average, it means that there are months which is higher or lower, you do the average, but overall the forecast, which is 95% confidence, CI confidence interval, it's pretty much accurate because we see that the shadow area is very narrow, so it's more or less it should be precise. Here we have the data. The 1 month would go from 4.25 4.2, like 7 basis points less. The same for the 3 months, will decline by 7 basis points. 6 months will decline by 7 basis points. And then here we have an average upward move of 6 basis points. And here we have 7, 10 and 30 year, we have an upward move of 8 basis points here, and 10 basis points for the third year, which all make sense. Okay, because the third year is more risky and it's normal that the average yield is gonna be higher by 10 basis points on average. So this basically is another data that explains why investors, they in this situation, when they have unrealized losses, they need to reinvest their coupons in short-term paper while trying to balance their portfolio or selling long-term bonds. And I want to give you another data. The Federal Reserve actually could be forced, for these kind of reasons, to keep interest rate higher, because banks, basically, to immunize their portfolio, they need short-term paper yield to be around 4%. Okay, so the Federal Reserve, probably for this kind of reasons of financial stability and all the plumbing system of the banking system, etc., and funds, etc., the Fed will have to keep rates at 4%, 3.5%. They won't be able to cut rates because they need to allow basically the yield curve to provide this function of immunization. Okay, having short-term paper that yields high enough to basically protect long duration portfolio from interest rate volatility. So there is also an element, the Fed won't be able to cut for fiscal policy, for higher inflation, and also because banks, they have exposure to bonds portfolio, and the immunization process requires banks to have a high yielding short-term paper to immunize their portfolio. So that's why this is very fascinating. Now I could diverge to a whole other argument, which is the neutral level of interest rate. And I will give you another notion, which is this one. So there are basically Federal Reserve chairman, like the model I believe is called Lowback and William. They created this theory of R star, or the neutral level of interest rate for the economy. And they say the R star is basically, it's calculated by improving the Taylor rule and then adding what is the output potential and the inflation expectation and some other things that right now I don't have I don't have under my hands, but the concept basically is to take a series of foundational macroeconomic variables like GDP output potential, inflation expectation, and then to have a measure of a neutral level of interest rate where unemployment is not increasing and inflation is not rising. Okay, so you have a optimal level of interest rate which makes function the economy at the optimal output level, at the optimal level of employment, at the optimal level of inflation. Okay, but now we see that this concept of R star, it goes in full collision with financial market interest rate, because the Federal Reserve will be forced to keep interest rate at 4% or 3.5% because we have financial stability factors of bond portfolio immunization, for which bond funds, they need to have short-term paper which yields 4% or 3.5% to cover their assets from interest rate volatility. Now, 3.5% or 4%, it's twice R star, the neutral level of interest rate, which should be 2%. Okay, so we are basically, not we, I don't agree with this thing, that there is this theoretical concept that there is a neutral level of interest rate, which for my knowledge, it's not complete, it's not true, because we see that in financial markets we have other level of interest rate which are not the same as the economy. Now R star is made to calculate the optimal level of interest rate for the economy, but the interest rate of the economy, it's decided by the Federal Reserve with the federal fund rate, and the federal fund rate basically decides or gives the input for the short-term paper yield. Okay, so the way the economy works, it has worked until now, is that the same level of interest rate are the reference benchmark for the economy and for financial markets, and this basically has brought this flawed concept of the neutral level of interest rate, which, to my knowledge, it needs to be improved, because I think people more prepared, more knowledgeable than me, they have academics that have a lot of experience, they worked in central bank, they should be able to recognize the basic fact that the level of optimal interest rate for the economy is not the same level of interest rate that it's optimal for financial markets. So the neutral level of interest rate is not one size fits all, but the optimal level of interest rate should be basically parameterized for the economic factors, but then there should be another federal fund rate which should be the benchmark for financial markets. So people that do invest in financial assets, they should refer to another benchmark. So what I'm saying is that central banks, they should have at least two interest rate, money market interest rate benchmark. One should be for financial assets and one should be for the economy, which basically brings to another series of problems, because you can have an arbitrage. If I borrow less and then I lend it more, okay, but in my thinking, the one size fits all neutral optimal level of interest rate, it's a flawed concept. It doesn't work. I think this should be worked better. It should, because the economy is not the financial market, the stock market is not the economy. So we should have interest rate for financial assets, which should tell me, okay, is the 10-year treasury, yeah, but the basic interest rate at which banks borrow to do financial markets activity, it can be the same rate of borrowing that Paul or I don't know, Melissa the plumber basically borrows at the bank. Okay, so we cannot, I think it's not right, but it doesn't serve well the economy and it doesn't serve well financial markets to have the same money market benchmark, which is the federal fund rate, or is the ECB interest rate, or is the Bank of England or Japan or whatever, basically one money market rate, one bank rate, which is a parameter for the economy and for the stock market. It can be that I'm wrong and I'm saying a lot of stupid things, that this already happens. it's this way. So basically there are a lot of what are the swap yield curves, there are lots of other varieties of things, but basically for this reason central banks, I think they should modify their model, and they should have a reference bank rate for the economy and a reference bank and another reference rate for financial assets. And this would be good for financial stability, because when we see that there are financial asset bubbles that are building up in the economy, that are inflating, in financial asset, we can, as a central bank, can basically increase the borrowing rate for financial asset speculation and keep steady the bank rate for the economy. So we need to decouple, we need to disentangle these two things. Okay, the mechanics of interest rate or bank rate, they need to be disentangled in order to have a better tailoring of what are the bank rate for the economy and what are the bank rate for stock market. That's why I digressed on this concept of the neutral level of interest rate, basically starting from this concept that the Federal Reserve, from this data, the Federal Reserve, it won't be able to cut interest rate, also because the banks, they need short-term paper that yields enough to cover their bonds, their cash flow mismatch, or their unrealized losses. While, for example, the economy maybe needs a 2% interest rate. Okay, so these two factors, they need to be disentangled. This is my thinking, and then probably I will work myself on other stuff. And I saved the charts, and yeah, we are back to immunization. So these are all the charts and all the stuff that I worked today. The basic volatility, we saw the Garch model. I hope you enjoyed the video, and I hope you'll basically you got some knowledge from me on what is the basic theory of bond portfolio immunization, and how volatility in short-term paper will be less than long-duration bonds. So all I can say is that we should expect higher volatility for all sovereign debt markets, and yes, we'll have to try somehow to enjoy this 2025. And if you like the video, please drop a comment, thumbs up, give me a like, and peace. Yeah, please, calm, enjoy your life. See you next time.